Broadcasting from the Investor Hour studios and all around the world, you're listening to the Stansberry Investor Hour. Tune in each Thursday on iTunes, Google Play, and everywhere you find podcasts for the latest episodes of the Stansberry Investor Hour. Sign up for the free show archive at investorhour.com. Here's your host, Dan Ferris.
Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value, published by Stansberry Research. Today, we'll talk with Marko Papic. He's a global macro investor with a brand new book out, whose title says he has a method for predicting the future. Bring it on, Marko. Can't wait to talk about that. This week in the Mailbag, comments and questions about government inefficiency, value investing, crazy anarchists, and more. In my opening rant this week, well, let's face it, there's only one topic right now, and that is what we will talk about. You guessed it, the 2020 U.S. presidential election. That and more right now on the Stansberry Investor Hour. Yes, there is one topic, and one topic only. As much as I would like to say that I'm the guy who's strong enough not to give in and be swallowed up by the zeitgeist here, can't do it. Got to talk about it. Well, we've talked about it already, so I need to revisit where we've been and see where we might be going. Now, I'm going to break with tradition and tell you exactly when I am recording this, because it's important this week. I am recording these words as I'm speaking to you on Election Day, many hours before the polls are due to close back east. Okay, so we don't know who's president yet. That's a good thing, I think, because, I'll remind you of what I've said, and then next week, we'll get to revisit this, and we'll get to find out how right was Dan, maybe even when we get to our interview, how right was Marko too, right? I think that'll be a good little exercise for us, kind of keep me honest. So what have I said? Well, I've said that elections, by and large, are not investable like long term. In other words, who the president is, it doesn't really matter. They're tradable, I've said, meaning there's a lot of noise around them and there's a lot of concerns about how a given candidate's policies are going to affect the economy and how that might affect the stock market or particular industries. So they're tradable short term, can be really good, but not investable, I've said. We'll see how I do on that one. And I've also said that I thought two good, really post-election, right? You can do them now before we know the result, but I've said they're kind of long-term, maybe 6 months or more, 12-month even. Probably less than 12 months, I'm thinking. More than 6, less than 12. Cannabis is one of them. And 2 episodes ago, we talked with our cannabis guru here at Stansberry, Tom Carroll. If you didn't listen to that, we got right to the issue of what the election means for cannabis, if it means anything different for either candidate. I encourage you to listen to that just because Tom is so knowledgeable about cannabis in general, and he's bullish over the next year, no matter who wins. So there's that. Then there's the other sort of post-election trade. This is much longer term, though, is Bitcoin, right? Because we think that no matter who gets elected, Trump, Biden, Kamala Harris, I don't know, Jerome Powell, whoever gets elected, they're going to have to engage in a substantial, or we strongly expect them to engage in a substantial amount of really coordinated monetary and fiscal stimulus, sort of Bank of Japan style between, the Fed and the government. And as we talked about before, right, the Fed can print money, it can buy securities, but unless that money is lent and spent, it just doesn't create the inflationary effect that people anticipate. In fact, that simple act of taking that bond, when the Fed buys that bond, takes it out of the market, that's actually deflationary, right? Because they're taking income out of the market. And they're not, they don't have it's not going into somebody's retirement account. It's just taking it out. and replacing it with $1 of reserves. So if the reserve doesn't get lent and spent, we don't see the increased demand relative to the supply of goods and services. We don't see price inflation. But given the way things are these days, mostly due to the draconian government response to the COVID-19 pandemic, we don't see how either candidate, whoever gets elected, we don't see how the president is going to be able to escape the need for especially coordinated fiscal and monetary stimulus. So that degrades the currency. Bitcoin becomes more attractive. So cannabis and Bitcoin, those are our trades. And we'll see how investable this election really is. This is what I've said, right? It sounds like I'm saying, well, it doesn't really matter who gets elected. These are the trades. Either candidate is good. Over time in history, it hasn't really mattered who the president was long term. But my gut is telling me something different. And I would feel remiss if I weren't completely honest. I think maybe I'm too caught up in the news. But I feel like certainly, I don't think it's controversial at this point to say that if Trump gets elected, there will be violence in the streets. And I suspect that the stock market will not like that at all. If Biden gets elected, we don't, if the party of love and compassion and caring gets elected, there won't be violence in the streets. If the party of love and compassion and caring doesn't get elected, then there will be violence in the streets. That's a joke. You know me. I don't care. Left, right, Democrat, Republican. I really don't care. I don't have a prejudice either way. But I just thought that was a funny joke that I saw on the internet. So, it's reasonable to expect that there's like a short trade if Trump gets elected. A short-term short trade, but a short trade nonetheless. And I couldn't help noticing Raoul Pal, the global macro investor guy who runs Real Vision, who we've had on the program, he did a little Twitter thread real quick, just a few things. And he noticed, as he put it, that he thought the market was anticipating this reflation effect. And hedge funds they're longer on stocks than they've ever been, and shorter on 30-year treasuries than they've ever been. And that is kind of interesting, right? And they're shorter on dollars, right? So over the long term, we have no doubt that the dollar is toast. But when you get these short-term phenomena, the odds on bet, the really good bet tends to be to go the other way. And I did this once before. I actually did this in public, and I did it in the Stansberry Digest, and Porter Stansberry had to go in the next day and explain, whoa. Long term, short term, whatever, his view is the exact opposite of mine. And I was saying, look, and it was April 1st, or the end of May, the last day of May, first day of April 2011. And of course, I said, the dollar everybody hates the dollar, so dollars are what you should own. And of course, that was the beginning of I think it was, minus 19 or 20% drop in the stock market through the first week of October, right? Because a strong dollar, if the dollar strengthens, there's more demand for dollars, maybe it means there's less demand for stocks. Well, there's less demand for something. If people are buying dollars, they're selling something. And with, hedge funds long as they've ever been on stocks, and you can see this phenomenon too. I was going to say, with hedge funds, as long as they've ever been on stocks, short as they've ever been in treasuries and dollars. And Raoul Pal said it's like 4 standard deviations. He said no matter how you slice it, they're shorter than they've ever been on treasuries. And just for a little gut check kind of a thing, I went to TD Ameritrade, and sure enough, the first thing I see is this article by their chief market strategist that says, Wall Street votes for spending. Whoever wins could reignite fiscal stimulus hopes. right? The reflation, which could be like good for stocks, good for gold, good for Bitcoin, all up as I'm talking to you. In fact, the S&P 500 and Bitcoin, as I'm speaking, are both up exactly 1.88 or they're fluctuating 1.89%. Interesting. So, meaningless, random data point, but the reflation trade is on. People are buying Bitcoin, people are buying stocks, people are buying gold. And my gut tells me that this is the right way to be, and that this strong dollar thing that could be a short-term phenomenon, that's the bet. And the bet is, maybe, I don't know, just call it the next 2 months, say, between now and December 31st. Short equities could be the trade. I personally own put options on big stock indexes. I also own a call option or two, and there are different time frames, right? So this is going to be real interesting, to say the least. The outcome in the stock market, I mean, here I am. I'm the guy who says it's not investable, it's tradable. And granted, I'm offering you trading ideas, not long-term investing trends. But, I'm saying, geez, this could be like a huge trade, but it's not. These are speculative ideas, right? What I'm describing are speculations based on all kinds of data points, how short the hedge funds are, how long the hedge funds are, the market's going straight up here on election day, up 2%. The sentiment is really high. There's a couple sentiment indicators. I don't want to get into the sentiment because you need to line them all up together. And even then, they're not necessarily good. But actually, I take that back. I will get into one of them because our guy, Mark Petrino, who we interviewed on the program, he was talking about the investors' intelligence. Percent of investors expecting a correction has dropped to a 3-year low, he said. It could be really bearish. He said the indicator has been reliable lately. It gave a signal back on September 2, right at the peak. So, he doesn't know how this plays out. Could be a little ominous. There could be a short trade here. We'll see. It's speculative, small amount of capital if you do anything about it. And, you should do your own work on these speculations. I'm just throwing ideas out there and telling you what I'm doing. All right? So I think that's enough said about the election. Okay? This is where we are. That's what I've said. It's election day as I'm speaking into the microphone. And the next time, the next episode, we'll revisit all this and we will see how it turned out. And maybe you'll even see by the time this very episode is published, which could be interesting, right? It's a good way to keep me honest. I don't know the outcome, and yet we're going to publish this thing after the outcome might be known. And I say might be known because there's a lot of talk about the fact that this election might be contested. It might take a long time to count up all the ballots. And, Trump is saying he's going to get his lawyers in gear as soon as the election is over. And I know his intent in saying that. I think I know it. But it sure sounds like it could be misconstrued that he's going to try to steal the election. So he should be careful. Well, Trump should be careful what he says a lot of the time. He's a really kind of a sloppy talker. He'll say anything, anytime to anyone. But in this particular case, it's kind of a sloppy thing to say. We'll see. We'll see how it all turns out. We'll see if there even is a new president by the time you're hearing these words after the election. All right? This is a nice little exercise, isn't it? All right. That's enough of that. Let's talk with Marco Papic and find out how to predict the future. Let's do it right now. You know how I'm always saying that I don't want this show to be too political? Because after all, it's a finance show, and some politics is appropriate, but it can get too much real quick, right? Well, maybe you're interested in politics. Maybe you're interested in American and global economics and politics. If so, you're probably going to be pretty excited to know that Trish Regan, the famous finance and political journalist, is now part of the Stansberry team. And Trish Regan has a brand new podcast. It's called American Consequences. You can find it anywhere that you listen to podcasts, iTunes, Google Play, anywhere. Or you can just go straight to AmericanConsequencesPodcast.com. And she's already had some huge names on the show, like billionaire businessman John Catsimatidis and former U.S. Senate candidate Tom Del Beccaro. So check it out. It's available anywhere you listen to podcasts, or just go to AmericanConsequencespodcast.com. I am really looking forward to this one. We're talking to the right guy at the right moment, and his name is Marko Papic. Marko is a partner and chief strategist at Clocktower Group, an alternative investment asset management firm based in Santa Monica, California. He leads the firm's strategy team, providing bespoke research to clients and partners on geopolitics, macroeconomics, and markets. Prior to joining the firm, Marko founded BCA Research's geopolitical strategy practice in 2012, the financial industry's first dedicated political analysis investment strategy. The GPS service generated Geopolitical Alpha by identifying gaps between the market's political expectations and the firm's forecast. Marko was a senior vice president and the firm's chief geopolitical strategist. Marko began his career as a senior analyst at Stratfor, a global intelligence agency, where he contributed to the firm's global geopolitical strategy, as well as its analyst recruitment and training program. In his academic work, he helped create the Center for European Union Studies at the University of Texas at Austin. He holds an MA in political science from University of Texas, Austin, and an MA from the University of British Columbia. He is the author of Geopolitical Alpha, an investment framework for predicting the future. A provocative topic. We'll get into that. It's a book that introduces his constraints-based framework to investors. Marko Papic, welcome to the program.
Thank you. Thank you for having me, Dan. It's a real pleasure.
So Marko, when we interview folks who are in your line of work, I always like to ask them, I like to start out by knowing, at what point in your life did finance become your definite career direction? Was it very early or after college, or when was it?
Oh, no. It definitely was not early. It was not after college. It was sort of when I realized that there was a market inefficiency in how people in my line of work at the time, which was political risk, talk to investment professionals, and how investment professionals talk to people in the political risk community. There was a real disconnect between the two groups of people. They had become over-professionalized from the end of the Cold War until 2010. And I remember exactly the day when I realized that I should do what I do now. I was at Stratfor, and I was pulled into this conference call with a hedge fund in Connecticut, and I barely knew what a hedge fund was back then, and this is 2010. And they ask, we need to talk to your Europe expert, and at the time I was a Europe analyst at Stratfor, and the question was, look, the German president just resigned, and we're going to sell everything. This is it. We've been waiting. We have a view. Europe is going to collapse. The euro is going to go down. And we want to use this as a catalyst. And I just look at the Polycom in the middle of the conference room, and I'm like, I have no idea who the German president is. And it was like a record skip, and the guy on the other side is like, what the F do you mean? We pay you a lot of money and you're the Europe guy at this shop. And I'm like, no, you guys don't get it. Like, I'm the best Europe guy. And I don't know who the German president is. Like, it doesn't matter. He's Queen Elizabeth. He kisses babies. Forget it. I don't know why he resigned. I guess I'll have to go back and look at the news. Anyways, the conversation ends. They were very appreciative because I gave them a straight up answer. Like, this doesn't matter. Like, go back to making money. And I remember the salesperson sitting next to me. She looked over at me and says, "Wow, these guys are really dumb." I remember like the kind of like it was thick with arrogance. Like, these guys don't know what they're talking about. And I thought to myself, like, nah, these guys can buy me to tutor their kids for the rest of their lives. Like, I would say yes. If they walked in here and said, hey, can you tutor my kids for the next 10 years? I'd be like, yeah, sure. That's good. Get me out of here. And so I just sat back and I said, they're not dumb. They're over-professionalized. They spent the last 20 years in this Washington consensus. We're watching FOMC, notes was part of your job, and they are not ready for what's coming. And the euro area crisis to me was the first moment when what was coming was a massive government interference in the way markets work. And I realized that I had a career. Literally, that was the moment where I realized there was a career to be made out of bridging these two communities and not, and breaking these walls of arrogance that I think epistemic communities, knowledge communities build up around themselves to make themselves feel professionalized.
Wow. That's a cool moment. I recognize that story from your book, Geopolitical Alpha. But yeah, very, very cool. Must have felt really, really good for you.
Yeah, I mean, it was good to know what you want to do.
Yeah, it is. It is good to know what you want to do. I agree. There's a time in your life when you go, this is the right direction. It just feels right. I've experienced a bit of that myself lately. But Marco, I can't help jumping right to the subtitle of your book. This is I can't turn away from this. It says an investment framework for predicting the future, because our listeners of this podcast, Marco, I'm not kidding you, they've heard me say you can't predict the future 100 times. And literally 100 times. So what is the constraints framework, and do you use it to predict the future?
Yeah, no, that's a strong subtitle. I will admit to that. And I'll tell you why. Because the number one thing that I'm fighting with that subtitle is this view in the financial community that you can't predict politics, which I 100% disagree. Not because you can predict the future, but because you can't predict the markets either. All right. So look, here's the thing. There's this sense in the financial community that we're professionals at, figuring out where the market is going. But over there, in that camp, on that corner, those people are charlatans and they look at chicken entrails. And I'm like, no. We're all charlatans. Let me just be straight up. We are all looking at chicken entrails. Don't tell me you're more quantified than those people in that corner. No. That we're all, but that doesn't mean you can't be systematic about how you put together the potion that becomes the snake juice you're selling. And let me just explain what I mean by that. It means that there is a systematic way to approaching uncertainty. And in the political world, the way to do that is not to talk to old wise men in smoke-filled rooms or these consultants who name drop within the first breath they draw. It's they will tell you the 3 people they had lunch with that week. The way to do it is to think about policymakers as essentially constrained individuals who will have to pursue policies, not that they say they want to pursue, but that ultimately the material context in which they live, in which they find themselves, forces them to do. So is Donald Trump going to leave NATO? The answer is hell no. Here's why. A, B, C, and D. Because he's constrained by the material reality in which the NATO alliance is actually quite meaningfully important for American geostrategic interests. Is he going to pursue a trade war with China? Yes, he will, because constitutionally, Congress has passed several pieces of legislation to give him quite an unencumbered, kind of platform when it comes to free trade. At the same time, he is ultimately constrained, and therefore he will both pursue a trade war and end it. And so it's not about preferences. It's not about what these people say they want to do. It's about the material world that exists. Now, there are different ways in which this constraint framework is used. For example, the shop that I started my career at that kind of gave me the idea that it's more than just what people want. It uses a very geopolitical view of the world. And I think that's really, really useful framework. I use part of that in my thinking as well. Geopolitics is important, geography, demographics, these kind of immutable variables over a long course of time are really relevant. But if you're trying to figure out what Joe Biden's going to do, if he has a Republican Congress, it doesn't really help you to think about America in terms of two oceans. It's not meaningful. So you have to kind of dig a little bit deeper. And so what I've done is I've expanded a set of constraints that I look at to include things like political capital, ability to pursue legislation to Congress, economic constraints, financial constraints like the bond market, and then legal and constitutional constraints. You construct a mosaic, and then you can have a pretty decent view, probabilistic view. It's not a sure thing, but you can have a pretty decent view of where these policymakers are going to take their policies over a certain period of time and bet against the market.
That's okay. So that's our kind of theoretical description of the tool or whatever. In the same way, well, look, before I say my next question, I have to say, you must be the most honest guy in finance, because I promise you, nobody is coming onto this program and saying, chicken entrails and snake juice, and you just need a more systematic way of making snake juice. So that's awesome. For that alone, like, yeah, you and I are simpatico. But the next question, the next thing that I simply cannot avoid asking about, of course, as we talk to you, and I'll just sort of pull the curtain back on the podcast for our listener a little bit. We're around 3 p.m. or so on election day that we're talking to Marco. This is really well timed, this conversation, because we can talk about it, then we'll see the outcome, and then we'll see how things play out. This could not have worked out better for us. So that's my next question, Marco. What do you think is what is happening? What has happened during the campaign? What do you think is going to happen in the election, if you have a view about that? And what happens after? What do investors do?
Well, first of all, let me refer back to your point about honesty and knowing that, look, you're dealing with a lot of uncertainty. Philip Tetlock wrote a great book, Super Forecasting. He also wrote a couple of other books, and he will tell you that in order to be a very good forecaster, you can't be parsimonious. You cannot just rely on one thing. You have to have an ad hoc method. And if you read my book, Geopolitical Alpha, you'll see that that's where the snake juice kind of comes from. It comes from being flexible, because policymakers face different constraints at different points of time on different policies. So let's talk about this election. How would the constraint framework kind of help you as an investor deal with the election and uncertainty? This is what it comes down to. To me, the biggest constraint on policymakers in the US over the next 2 to 10 years is going to be that the median voter has moved to the left on economic policy, period. Massive empirical evidence of this. I know a lot of listeners, this is a, investment, finance kind of community we're speaking to. There's going to be a lot of like fist shaking at my statement. I'm sorry, but it's just the fact. The median American has moved to the left, including, and this is most important, Trump voters themselves. Like, who is out there shaking their fist at the budget deficit other than like Mitch McConnell? Nobody. So the median voter is really the price maker then, and policymakers are just price takers. So what I would say to you is that this election is between two outcomes, not Joe Biden versus Donald Trump. This election is between two outcomes, which are pro-growth and anti-growth. The pro-growth outcomes would be the blue wave and a Donald Trump re-election. Ironically, both of those are bad for bonds, good for stocks, relatively good for stocks, at least in nominal terms, and ultimately, I think, negative for the dollar, because the U.S. is now at the margin of unorthodoxy. We are at the frontier. We're at the frontier of unorthodoxy in the U.S. I think we're going to lead the rest of the world into this world where fiscal policy becomes extremely meaningful to growth, and we do not reverse it as we did in the last cycle, where we pretty much had the Tea Party rebellion within 18 months of the recession, 2010, and we had austerity.
Okay, Marco, I want to interrupt. I just want to make it clear. You said Donald Trump and blue wave, not red wave, blue wave, right?
Yep, they're the same.
Okay, interesting combination. Yeah.
No, they're, to me, from a macro perspective, I'm a macro investor. Now, obviously sectorally, there's going to be differences. But, you don't want to talk to Marko Papic about sectoral implications of these two presidents. I mean, first of all, I think they're fairly obvious. Second of all, that's not what really interests me. I'm talking about big picture. In big picture, I think both Donald Trump and a Joe Biden, unencumbered by Republicans in Congress, are going to get the same outcomes in terms of fiscal policy. The argument against this that I often get is, well, Nancy Pelosi will be a problem for Donald Trump. On fiscal policy? On fiscal stimulus? No, of course not. She won't. She will actually push him towards the median voter, which is to have more. And I think this is a profound shift in American policymaking. And I think that's why there's that outcome. That outcome has about 70% probability, I think, of coming true. Now, there's a 30% probability, which is higher than what I think the market is pricing, and that's that I'm wrong, and that we're all wrong. Look at how the 10-year has been basically creeping up. The yield has been creeping up in expectation of this pro-growth outcome being true, revealing itself. I think there's a meaningful 30% probability that we actually have a hiccup in this very neat story of reflation and fiscally led, growth. And that's that Biden wins, but he doesn't get the Senate. In that case, now that's the gridlock outcome. Most investors have in the past really liked that. You can look at a number of sell side reports that will tell you how gridlock is great. Not in today's paradigm. Today's markets are fiscally led. They're addicted to fiscal policy. And I think the market, if we don't get clarity on the Senate tonight, which we may not, it's pretty close, I think the market is going to have a hiccup because it's going to have to ask itself, will Republicans in the Senate, if they were to retain the Senate, give Joe Biden what he wants on fiscal policy? Now, again, the counter to that is, but Marco, doesn't gridlock mean less tax uncertainty? And my view on this is kind of controversial. I think there's very little chance that Joe Biden will be able to raise taxes, at least on corporates. I think on individuals, for sure. My mental map for this is 2017. Donald Trump comes to power. We have a red wave. We have a unified government behind Donald Trump. But his marginal senator is a liberal Republican. So the marginal senator becomes Susan Collins, Lisa Murkowski, and John McCain, who refuse to repeal Obamacare. And similarly, I think in 2021, you have to understand that the marginal senator in the Senate is going to be a conservative Democrat, say Montana's John Tester, or Mark Warner from Virginia, who's a venture capitalist, very successful man who's done a lot in finance. So are you telling me that these relatively centrist, conservative, or Manchin, by the way, in West Virginia, who is a straight up conservative, are these conservative centrist Democrats going to pass tax increases of 8%? And my answer is no. So you have this very binary outcome in terms of probabilities, where the constraints on Biden on fiscal policy will be non-existent. He will spend a lot, but the constraints on tax increases are considerable. And so that skew between the two sets of material constraints tells me that if we do get a blue wave, bonds sell off, equities do well, dollar doesn't. Donald Trump is very similar. You don't have a threat of tax increases, obviously, so that's a positive, but he will spend as much as Biden, maybe not exactly the same, but he'll spend, as he has proven he will. And then the only downside in all of this is if the Senate turns red or stays red, stays Republican. So what does that mean for investors? I think for investors, it means that we could be in for a surprise tomorrow. The bond market could rally in the short term as the uncertainty on the Senate outcome continues. We may be in a situation where we have to wait for Georgia's, second round in December to get a clarity on the Senate situation, if Biden wins. And if Biden loses, then I think that it's pretty much smooth sailing. I think for the most part, the market will breathe a sigh of relief and say, well, Donald Trump, he may have his flaws, but one thing we know is he can get fiscal stuff through Congress with Nancy Pelosi. They're actually quite an interesting pair, and they work actually quite well together when it comes to indebting America for the future.
Interesting.
I just insulted all your listeners, by the way. Literally all of them. Liberals.
No. They're a pretty thoughtful crew, actually. I get a lot of really thoughtful, intelligent emails from these folks every week. So I think you'll be better received maybe than you anticipate.
Awesome. Good.
So tell me again, let me just go back to, you said there could be a hiccup. Because I wonder about this too. And I'm not a geopolitical guy, but I look at things like sentiment and positioning, and people want to be short, the 10-year, 30-year right now. They want to be short the dollar. So when I see that, I think, well, long term, I think the dollar's toast. But when we get these short term extremes in sentiment, a great way to raise a bunch of cash, if you want to, of course, is selling equities. So that's kind of where I was on the possibility of what you term a hiccup.
Yeah, so let's talk about a hiccup. Everybody talks about a contested election. Look, I don't think that's really the problem. I think the problem, sure, that could be the hiccup. Whatever. You've heard it from other people. I'm not going to repeat it. I think to me, it's that we don't know the outcome of the Senate race. You could have a world where Biden wins Texas. Yeah, I mean, you could have a world where Biden wins Texas, but some of these Senate polls are actually quite close. The Democrats have to gain 4 without losing Michigan, and Arizona looks pretty much locked for them. But North Carolina, Georgia, Colorado, Minnesota, Montana, Maine, South Carolina, they're all within the margin of error, and they need to win 4 of those. And if they end up having to rely on Georgia's likely to go to the second round, and so we have to wait until December. Now, who's going to be motivated in December to vote in Georgia? Let's say Biden wins. Who's going to be motivated to go turn out for the Georgia Senate election? I think it's going to be Republicans who are going to say, like, okay, fine, Biden won, great, but you know what? We want to put some constraints up on him, some guardrails. So I'm going to show up and I'm going to vote for the Republican candidate in Georgia, and then we have this. That's why I think it's a 30% probability that I agree with you. The market is not pricing in. The 10-year has been selling off. The 30-year, as you say, positioning, I think, is at an all-time shorts. Same with the dollar. And I think that would be how you get the hiccup. There's uncertainty on the Senate. And that's why I'm not really interested as an investor. I use politics and geopolitics the way a value investor uses valuations, or the way a technical analyst uses charts. Politics and geopolitics are my methodological bias. That's what I'm the best at, if you will, as an investment professional. But to me, I don't think there's any alpha to be generated by getting Biden or Trump right. I think it's about this Senate constellation, and that's where I don't think enough has been written about. I don't think people have focused on it enough, and I think 30% is a 1 in 3 odds of a meaningful reversal of some of the positioning you're talking about, because it is a hiccup that could last 3 to 6 months. There's 2 other things that I think we should look at, by the way, Dan, if I can quickly just add these 2 other issues. Joe Biden doesn't become a president until January 20th. So there's going to be a period of time where he's just kind of talking on the sidelines. And I can see him talking about lockdowns from the sidelines. So one of the things that could happen is that the market has to price in a meaningful shift in how America has dealt with COVID. Instead of this kind of localized state by state approach, suddenly Joe Biden is out on the sidelines chirping at Trump like, yo, we need a federal shutdown, which is likely impossible to do. But he's going to be like talking up about, look, we have a third wave. It's huge. You haven't done anything. The market might have to respond to that, even though I believe that by the time he becomes president, the third wave will start breaking, as it has in the past. It's usually a 4 to 8 week kind of a thing. And then the second thing that I worry about is, what does Trump do during his lame duck session? People talk about lame duck as if the president is a lame duck, but constitutionally, and again, in terms of constraints, he doesn't have any constraints on foreign policy in those 3 months, like none. He can do whatever he wants. And if you go back to 92, Bush Sr. lost the election and then invaded Somalia with 30,000 troops in December, trying to lock in the populist leftist Bill Clinton from Arkansas. Bush was worried that this kind of a guy from middle of nowhere was going to come in and be an isolationist. So he tried to lock in the coming president with a foreign policy action. And could Trump do something similar in those 3 months? So I feel that even if we have this blue wave where the market kind of cheers certainty, VIX collapses, the 10-year sells off some more, I think there's a couple of more things from now until February where we could have a hiccup and meaningfully change the direction of the positioning that you're referring to.
Very interesting. Man, I'm so glad that we're talking to you. I really am. There was something that I saw that I wanted to ask you about, Marco. I noticed a couple of reports of the voter turnout is already pushing record numbers. Does that mean anything to you at all?
I think marginally, man, marginally. I think too much is made out of this by the media. They're trying to spin this as super positive for the Democrats. What I would say is that, Nate Silver and like professionals, folks who look at this 12 hours a day and don't do anything other than trying to predict like the US election, they will themselves tell you that this is cannibalization. The Democrats are cannibalizing their vote on the election day. So that's the first thing I would say. So if you're kind of a Trump supporter,
what does that mean?
Well, it means that these people were going to vote on election day, but they just voted early. There's no that's what it means. It means that on election day, we just had a lot of people who would have voted on election day vote now. So a lot of the media is reporting that there's a skew towards the Democrats in the early votes, and my point is just that Democrats could have voted on the election day, but it does mean the turnout is going to be huge. The turnout is going to be very, very, very elevated, and I do think that hurts the incumbent. Generally speaking, if you're the incumbent, a huge turnout kind of tells people are angry. It doesn't mean people are really happy. And so I don't think the skew towards the Democrats means anything. I think that's a wash. But I do think that the odds that this turnout is going to be huge is a problem for the incumbent. Similarly to how 2018 midterm election, we had the highest turnout 2 years ago since 1914. And it was a pretty robust, and it was a pretty robust victory for the Democrats. The only thing Republicans can say is that they held the Senate, but the Democrats were defending a vast majority of the Senate seat because the Senate goes 1/3, 1/3, 1/3, right? So that cohort of 2018 Senate races was heavily skewed towards Democrats, and they managed to not lose more seats, which was impressive given how much more seats they were defending. And so overall, I think it's not a good sign for Donald Trump. But on the other hand, he doesn't have 0% probability of winning. I think only The Economist is really pegging him at under 10%. There's still paths for him to win. I think, just empirically speaking, the math doesn't really help right now for Donald Trump.
Yeah, it seems like just everywhere you go, people who are betting real money, making odds, any poll you look at, the idea that a lot more people are turning out, it all points in one direction. But the only thought in the back of my head, Marco, is that I feel like we were saying all this exact same stuff 4 years ago.
Absolutely.
Like right up until the odds didn't change until it was almost 9:00 Eastern time. I mean, yep. The odds didn't start going the other way. It was crazy.
Well, that's why, look, the prediction markets, you got to understand, I mess around with predicted. I think it's cool. It's fun. The maximum bet I can make is $800. That's the maximum bet you can make. So you got to be very careful. This is a tool for consensus. And so I think the difference this time around, though, is that there's a meaningful divergence between professional forecasters who are more confident this time around. And I don't mean New York Times, and I don't mean Huffington Post, which I think in 2016 gave Trump 1%. I mean Nate Silver. A lot of people don't like Nate Silver, but he did give Trump 32% probability of winning. Look, if you're a basketball professional and you shoot three-pointer at 32%, you're a marksman. You know what I mean? So in
yeah, that's right.
In Silver's defense, that was quite a bit. I gave Trump 42%. And last time around, it was basically a toss-up. And I thought that Hillary Clinton was slightly favored. But yeah, I thought that this election was a toss-up. And I had said in early 2016, look, he has a path to victory that goes through, a turnout of the white voters. I think this time around, though, what's different? This time around, the context is not favorable to him. It's, you could argue this isn't really, you could argue it's his fault. It's not his fault. I don't care whose fault it is. But the fact of the matter is that, he had 3% unemployment rate, 12 months ago. Now it's substantively higher. He's making a case that there's a V-neck recovery, and I'm sympathetic to that view. It's just that those are the facts. The context is much worse. An incumbent fighting a re-election in a post-recession environment is just very difficult for them to win. The other thing I would say that's different is that if you look at the polling, they are much more calmer, more ossified, unlike in 2016. And then the final point I would say is that there's a PTSD kind of way to think about this. So I think a lot of people have PTSD from 2016. and they feel that, well, we should throw out all these polls. The polls weren't that wrong. They were wrong by 1.2%. So anyways, I don't really want to spend too much time talking about the forecast, because ultimately for us as investors, I think what's important is to get away from Joe Biden versus Trump and to think of this election in kind of pro-growth, anti-growth outcomes. I think that's really the key. And as you said, everyone's aligned on the pro-growth outcome, and I do think it's the favorable. It's 70% probability of that, but there's a nice juicy 30%, 1 in 3, and I don't think enough people are kind of worrying about what happens to the Senate.
Right. So maybe that's your short-term trade, and it takes a while for that to for the confidence to return, and then who knows.
Hey, listen, Dan, that's literally what geopolitical alpha means. And I don't know how many people like gamble on sports on this podcast, but I don't, but I do. I'm fascinated by it. And what we have to understand as investors is that we need to approach this the way a professional gambler approaches sports. Why? You don't care if the Patriots beat the Bills. You're not a fan of the game. You're not a fan of a team. You just look at it and you're saying like, okay, they're favored by a touchdown, but it's in Buffalo, it's cold, and Tom Brady is not the quarterback anymore. Like, I'm betting against that line. You're not betting that the Patriots are going to lose. You're just betting against the line. Similarly, in politics, I think the number one way that investors make mistakes and don't generate geopolitical alpha is that they think this is about outcomes, that this is about who wins. We're not doing that. We're simply putting a bet on. And right now, I think, given what you said, given positioning, I think there would be a short-term tactical trade, as you say, that kind of says, hey, maybe the bonds actually rally in the short term, because that 30% probability is not being priced in. In other words, the market is right now giving the blue wave team, a touchdown and a field goal over the anti-growth outcome, and that's maybe too much.
Gotcha. Actually, that's a great analogy. I love the sports analogy there. That works great. And I love the fact that you are not taking this as a straight Trump versus Biden trade. This all makes a lot of sense to me. I'm really, really glad that we're talking to you. We're talking to the right guy. So here's my it's not my final question, but maybe we'll ask you another question or two. What I want to know, like, it's nice to hear people talk about their strategy and what they would do and what the outcome they think are going to be. But let's face it, you and I both know it's like where the rubber meets the road. It's not what you say, it's what you do. So I wonder if you could, I don't want you to give away the secret sauce or anything, but if you could share your ideas about, portfolio positioning, or, maybe how things might change depending on, outcomes that we get from this election. Just give us a couple thoughts there.
Yeah, of course. So look, Clocktower Group is an alternative investment management firm. So our business lines, are much more illiquid. And so I don't manage public equities or public assets. We have a VC in fintech. We are very focused on the private markets. We seed hedge funds. So I communicate quite a bit with managers in the hedge fund space. So I kind of know where the universe is broadly positioned. And I would say you're by the way, absolutely correct about positioning. And then finally, we also have a very interesting China business as well, where we think that seeding managers in China will be an interesting business opportunity. So given all of that, that's kind of my caveat, that when I give you my views on portfolio, this isn't something that we're actively putting money on. These are just kind of my personal views where I think the market is going. And I think that beyond the short-term hiccup that we're discussing, where all this positioning gets washed out, I do think we're in a dollar bear market. We're starting a dollar bear market. And it's because America is at the frontier of this monetary policy and fiscal unorthodoxy. It has first mover advantage. And I'm sure a lot of listeners will be like, wait, advantage, dollar bear market? I don't get it. Well, of course, it's like a way to reflate the economy. May not be a bad thing to enter a bear market. Now, a lot of dollar bulls, they build a straw man argument against the bear argument. And they say, well, Marco, you're a defeatist. You think the dollar will cease to be a reserve currency. I'm like, excuse me, but the dollar's been in 3-decade-long bear markets since 1970. And America,
Yeah.
America didn't lose like geopolitical power in that time. In fact, it just gained it. You can have a dollar bear market and America can still have its reserve currency. So relax. This isn't about that. This is about the fact that central banking has basically told us where it is. The Fed is anchored at zero. They're going to let inflation overshoot. America is going to fiscally stimulate much more than I think other major economies. This is going to have this upside down world where real yields go down. And if I tell you that I'm a dollar bear, then you can fill out your global asset allocation based on that view. And so that means a lot of, I think, EM longs, small caps versus large caps as well. I think XOP, energy producers, I think there's going to be an interesting bid after the kind of election uncertainty gets away. I think that we're at the start of a new bull market, the start of a new cycle. Whether vaccine comes or not, I think it almost doesn't matter because humans are becoming increasingly more desensitized to COVID-19. You can see this in the mobility data. Every wave has less and less of an implication for the macroeconomy. And so I would be short bonds, long equities, especially long rest of the world relative to the US, short dollar. And in terms of emerging markets themselves, I really like Chinese tech and also Latin America. I think if you look at LATAM relative to EM, broad EM, it's been getting killed for good reason, commodity bear market. I think commodities are going to be well bid over the next couple of years. So that would be my kind of asset allocation and positioning over the next 5 years.
Just real quick, do you have a view on the energy sector, like oil?
Yeah, so I would be bullish over the next 12 months. As I said, I mean, there's two sources of bearishness right now. It's the third wave and potential lockdowns that are as severe as the previous lockdowns. I would say that if you actually read through what the Europeans are doing, you can see that it's not the same as February, March. I think political constraints on 2020 Q1 lockdowns are huge. Why? Because earlier this year, look, Dan, we thought, well, I didn't, but like the consensus was that, the WHO mortality rate of 3.4% was true. Of course it wasn't. The denominator, like the ratio was off. We didn't have the cases. We now know that the mortality rate is somewhere between 0.5 and 1%. So no, this is not a flu. Trump is wrong. However, at the same time, human beings are going to have a different outlook towards a risk of 3.4% mortality and 0.7, 0.5, especially given different applications of that mortality rate in different age cohorts. And you can see this in the mobility data. If you plot a Google mobility chart with cases, you can see how the correlation was 1-to-1 in Q1, Q2 of this year. And then every subsequent wave, we as a society, like the median human, just cares less and less. And, I'm not making a statement whether this is good or right or wrong. I'm just saying a fact. So I think that that's the first bearish view on energy is, wait, this is going to continue. We're going to have more lockdowns. And my argument is there will be diminishing returns to each lockdown. In other words, fear has a short half-life. We desensitize. The second issue is Middle East. There's this assumption right now that if Joe Biden wins, like boom, there's like 3 million barrels coming out of Iran tomorrow. And I would push back on that. I think, first of all, he's not going to become a president until January. That's the first issue. January 20th is when he gets inaugurated. I think he's going to want he's going to want to extract something out of Iran. They're going to push back. They have an election in June of this year, so they might delay meaningful conversation with America until that's over. The point is that there's that. There's also then the risk that Israel and Saudi Arabia say, hey, hold on a second. What? No, we don't want that barrels to come online. They're going to push back, whether through kinetic action, whether through Saudi Arabia could take matters into its own hands in other ways. My concern is that right now everyone's focused on China-U.S. relationship. I'm someone who's been writing about their relationship for a decade. I've been a huge kind of a pessimist. I've said the rivalry would get more and more heated. But now I think like pendulum of the attention has moved too much to US China. And I don't think people are focused enough on the Middle East. So I think the combination of geopolitical risk in the Middle East and a combination of a surge in demand, once we realize these lockdowns have a diminishing impact on mobility, I think will create a very interesting entry point for things like XOP, so energy producers and oil prices.
All right. So, Marco, actually, we are getting long on time here. I have a final question that I ask all my guests. I think it's an especially great question for the Geopolitical Alpha guy. And the question is simply, if you could leave our listeners with one thought today, what might that be?
You know what? Instead of giving you a view on where to seek out geopolitical alpha, I'm going to give you kind of the tools to generate it yourself, because that's what I'm obsessed about. You know, like when I started writing this book, somebody asked me, Marco, why are you giving away your framework? Like that seems, silly. And well, because I'm passionate. I'm passionate about seeing people succeed around me. And the other issue is, just because I tell you how to swing a racket doesn't mean that, you're going to become #1 tennis player, right? So like, but at the same time, I do like, I want to share the framework. And if I can tell you anything about this framework, constraints, material constraints, this and that, blah, 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 blah. Look, it comes down to this. The constraint framework, the secret sauce of this framework is that by focusing on the material world, not only are you focusing on things you can measure and observe, but it's also things where your bias and your ideology has less influence than when you think about policymakers and their preferences. And so if there's anything I could leave investors with, it's that we cannot invest with any bias or with any kind of thoughts about what is right or wrong. There is a time to be a human, and there's kind of a time to be an investor. And when we have our investment hats on, I think we need to bathe ourselves in indifference. And that's kind of the message of the book. And I think the framework is conducive. The framework is conducive to making investors be as unbiased as possible. Doesn't mean you're going to be fully unbiased, but I think it gets you there. And so I hope that folks read it, and I hope they like it. And feel free to reach out to me and tell me you hate it or you love it. Yeah. So thank you for the opportunity to talk about this, Dan. I had a lot of fun.
Well, I haven't read the whole thing, but what I've read I really liked. So put it that way. Yeah, we will reach out again. I'm glad you said that. Maybe we'll check in with you in 6 or 12 months, or maybe we'll let the next administration go a year or two, and then we'll find out what you're thinking then.
You know what, Dan? I'm sure that nothing else is going to happen for the next 5 years. I think it's going to be. I'm sure there will be nothing else geopolitical to talk about.
There you go. That's right. We won't need to be talking to you. It's going to be really boring. It's going to be boring. Yeah. So we'll do that. And like I said, thanks so much for being here. And I guess that's bye-bye for now. Thanks.
Yes. Thank you so much, Dan. Really appreciate it.
All right, man. Talk about the perfect person to speak with at the perfect moment in time. I'm really, really curious as to how the next few days work out and how the next several months work out. And, I can't wait till the next time that we, sort of check in with Marco and find out what he's thinking then. Really great conversation. I hope you enjoyed it as much as I did. All right, let's check out the mailbag. Hey guys, I get a lot of emails asking, what happened to Buck Sexton? Well, Buck Sexton is not on the podcast anymore, but he's doing a lot of other things. And he's a former CIA guy, and he knows all the ins and outs of what's going on in Washington, D.C. And he's written a brand new book called The Socialism Survival Guide to help investors and other people navigate the political trends, the disturbing political trends that we've talked about on the podcast fairly recently that are ongoing today in our country. And Stansberry Research wants to give you a free digital copy of this book. Yeah, free. Buck Sexton's new book, free of charge. I kind of had to do a double take when I heard it myself. And to get it, you just go to www.investorhourbook.com. You don't need a credit card or a subscription or anything. Just get a free copy of the book by going to www.investorhourbook.com. That's Buck Sexton's brand new book, The Socialism Survival Guide. Check it out. In the mailbag each week, you and I have an honest conversation about investing or whatever is on your mind. Just send your questions, comments, and politely worded criticisms to feedback@investorhour.com. I read every word of every email you send me, and I respond to as many as possible, and there are many to respond to this week, so I'll dive right in with SC. And SC says, "Hi, Dan. I've got another theory about why unified administrations yield 14.52% annual market returns." Now, before I continue with SC, you remember last week we discussed this. We gave some numbers, some statistics on how stocks perform in various administrations. And there was this one statistic that said when it's all Democrat or all Republican, House, Senate, and the White House, it doesn't matter which one it is, but when it's all one party in those three, historically, the market has risen 14.52% per year. Just a weird statistical anomaly. And I said, maybe it's because the market likes the predictability of believing it knows how a given party is going to behave. So SC continues, he says, his theory is unified administrations presume that their party will get all of the credit for improvements in the economy and in the market averages. The long-run unintended consequences, that is, inflation, will be someone else's problem, and their actions will be long forgotten. So unified administrations, either Democrat or Republican, will spend more money and make greater attempts to juice the economy and the averages. In a mixed administration, the branch of the legislature that doesn't share the party affiliation with the president will be much more stingy about juicing the economy. They will claim to be doing the responsible thing, albeit for partisan reasons, SC. SC, I think this falls under the general idea that I had that the stock market believes that there's a predictability. I think you've gone in and you've described the nature of that predictability, right? So the long-run unintended consequences are some other future administration's problem. We're all in the same party in the House and Senate and White House. We all agree, let's just get it done and juice the economy. Yeah, I think that makes sense, and I think it lines up well with what I said. So I definitely am receptive. I'm picking up what you're putting down, SC. Next comes James K. And James K has a lot to say here. I'll try to pare it down a little bit. Sorry, James, can't read your whole thing. He says, "Hi, Dan, I'm just listening to your episode with Matt McCall. In your rant, you mentioned an article that talks about so-called spurts of growth during times of crisis. Dr. Robert Higgs wrote a book called Crisis and Leviathan on this topic, and I highly recommend it. Also recommend Higgs as a guest for your show. If I remember correctly, Higgs strongly disputes the idea that GDP, or productivity in general, goes up due to government intervention. And he says government is inefficient in everything they do, period. If the numbers say otherwise, you better look again at the source of those numbers." Again, going from my faulty memory, Higgs focused on the misguided notion that World War II pulled us out of the Great Depression. And then he concludes, forced central planning is always a bad idea. And he also mentions this is typically Bastiat, Frederick Bastiat, an economist. This is typically Bastiat's struggle between the seen and the unseen. We can all look back and see the tanks, bombs, and airplanes produced by the war machine, but we cannot fathom all the lovely, peaceful things that would have otherwise been created by entrepreneurs and inventors for willing consumers in a free market. Great work as usual. Keep it up. Loyal listener and true wealth subscriber, James K. James, I'm going to let your comments stand on their own. I am highly sympathetic, and it makes a lot of sense to me. Next comes Pete L. "Hi, Dan, longtime listener here. Great job, great interview with Tobias Carlyle. Regarding modern monetary theory, What if Congress, the White House, the Treasury, and the Fed are all in on MMT? How do we go about investing to protect against this crazy MMT idea put together by lifelong academics that have never run a business in their lives? I'm thinking about the answer to this question often. Seems very likely, no matter who the US president is, we seem to be going all in on the MMT idea. I want to make sure that I invest, save appropriately, or is cash trash, as Mr. Dalio touts? He's talking about Ray Dalio, founder of the biggest hedge fund in the world, Bridgewater Associates. And he continues, I know you are going to say Bitcoin, gold, and silver have a place in fighting living with MMT. Let's hear what you have to say about investing in a deranged long-term MMT dystopia besides these three asset classes. Thanks, Dad. You're a rare voice of reason, intellectual thought in America's strange world of disinformation here in October 2020. Pete L. Thank you, Pete. Kind words, good thoughts, good question. So what I have to say about investing in a deranged long-term MMT dystopia is, believe it or not, I think it takes probably longer than most people anticipate for it to become really dystopian. Even as I say that, my gut says, oh, Dan, you better be careful. This thing could get ugly quick. And so then where do I wind up, Pete? I wind up back where I always am. Be truly diversified, because what you're really asking me, whether you agree with this or not, Pete, I really think your question boils down to what speculation can I have if I'm highly certain that a particular deranged long-term MMT dystopia is in our future. What I'm saying is, I don't like MMT on the face of it. It seems like a bad idea to me, but you still can't pretend that you have a lot of certainty about the outcome. That's the problem. No matter what, it's really problematic to say, oh, well, we're going to get inflation. That's all there is to it. Think about all the people who said, we're going to have terrible inflation back in 2008 and 2009 because the Fed had to print a lot of money to fix the financial crisis. They were, I suppose if they bet on the stock market, they were right. But, otherwise, they walked straight into a pretty steep bear market in gold that started in, 2011, lasted through, just call it 2015, early 2016. Gold and gold stocks together. So you really have to be careful about looking inside your own thinking and finding the places where you're trying to get certainty about the future and wanting to bet on that. So that's why I say hold your stocks, hold your bonds, but also hold plenty of cash. Also hold gold, silver, and Bitcoin. I feel like I'm disappointing you, but that's what I have, and that's why I have it, more importantly. I think the why is important. When you know the why of your assets, when you know the why of your portfolio, you hold it for conviction, and it'll work harder for you, I believe. Also, I have to point out, for example, I read this thing called The Daily Shot. It used to be in the Wall Street Journal. It's not anymore. You have to subscribe to it separately. A bunch of charts that they put out every day. And one of the recent editions last week was they made this point that, we had this big drawdown on, what was it, I think it was October the 28th. So the market was down, and they said, the traditional market hedges didn't work that day. The bonds and the gold and I think utilities and maybe one or two other things that they pointed out. They said they didn't work that day. Because when people want cash, when the market is really heading straight down, people want cash. So that's where I am, Pete. I'm not changing my tune, man. Be truly diversified. Stocks, bonds, cash in the financial system, gold, silver, Bitcoin, and whatever kind of other thing that you know about, we mentioned whiskey and wine and guitars and all kinds of collectibles and things that get you outside the financial system. Great question, great topic. Brian E. writes in and says, Dear Dan, seeing that the crazy anarchists have moved north out of Portland to your town, just a short note wishing you the best and hope you and your family are not being impacted by the lawlessness. Keep up the good work, Brian E. Brian, thank you. I have a lot to say about that. I'm kind of going to keep it to myself. And I hope you're right. I hope that the unrest, as they like to call it, my father laughs at that term, unrest. He says it's violence. It's not unrest. They're burning buildings down. The point is well taken. Yeah, we'll see if the unrest makes its way to my door. I'm hoping not, of course, but I think not, probably. Next is Arnold C. Arnold says he's an investor who started with $10,000 and made $2 million. First of all, yay, Arnold. I'm applauding you. Awesome performance. He continues, problem with value investing, the real assets of companies do not display on the balance sheet. The management and employees, patents, research and development, intellectual property, and so on. Arnold C. That's not the problem with value investing. That's the problem with book value as a measure of business value. Just to be clear. Problem with value investing is that, if people want stocks that are super expensive and they want to speculate and buy things that are growing real fast and not buy the cheapest stocks in the market, the capital flows the other way. Plain and simple. But eventually, the force of gravity kind of kicks in and it generally goes the other way. We'll see if this time is different. I suspect this time is different will be as big of a mistake as it always is. But I'm glad you wrote in. Next is from Theron S., who, thank you. I used to call Theron TJ because I didn't know how to pronounce his name. He says it's sort of a weird Cajun thing, I think he said. Thank you, Theron S., for telling me that. And thank you for writing in, because I've disagreed with you, but you're a very thoughtful correspondent. And you keep writing in. I appreciate it. He says, Dan, like you, I have serious reservations about the ultimate success of MMT. Unlike you, I think post-COVID-19, it will be de facto the way the monetary system will be handled. I'm going to stop you right there. Gosh, if I said that, I don't think I feel that way, Theron. I think that we will be hearing a lot more about MMT, and de facto, you're right. They will be printing money and buying stuff, whether it's, treasury securities or ETFs, as they're doing now, bond ETFs, or even outright equities or whatever. Remains to be seen. But I also think there will be a coordinated effort between the Fed and the government, right? The Federal Reserve and the government. The monetary and the fiscal will coordinate and will wind up with de facto MMT. So the twin levers there are printing money and buying stuff and raising taxes. So anyway, Theron continues. The traditional way of explaining sovereign debt will not change, but behind the curtain, MMT will prevail. The reason is simple. With the astounding amounts of fiscal stimulus being issued to keep the world economy afloat in response to COVID, there's no other way to manage that level of debt. A side benefit of MMT is the transparent way it explains the accounting process of central banks and their corresponding treasury departments. Here's an example of counterintuitive nature of fiat money accounting. If today you were to pay your taxes with cash, that currency goes into the shredder. What does that do? It reduces the money supply, and that's how MMT proposes to control inflation by raising taxes. Yep, that sounds crazy, and I'm not sure how you sell that notion. Here's an idea. The government could create a new program. Let's call it Whip Inflation Now, or WIN. But to fund this effort, we have to raise everyone's taxes. Yep, that might work. Keep up the great podcast, Theron S. There may be some short-term effect in which that will work, because God knows when you tax something, you get less of it. So, if you tax people's incomes, you give them less incentive to go out and earn. But as I've said before, I think it is sheer insanity to trust any human being or group of human beings who believe that they can control, for the benefit of all, a $20 trillion economy from the top down with two simple levers of money printing and taxes. They are the Wizard of Oz, who was a complete fool who knew nothing and had everyone scared. He was a complete fool who knew nothing. There was nothing there. And I think that's who the Fed is. It's the Wizard of Oz. Complete fools, they know nothing. All right. Next is Sanjiva S. I think we have two more of these. Sanjiva S. says, hello, Mr. Dan Ferris. I regularly listen to your podcast. It's always interesting and enlightening to listen to your thoughts on the current market situation. Unlike you, I am a momentum trader, not a value trader. I have a question for you. Assuming you're an investor in the dot-com bubble, you made money to your top in the dot-com bubble in 2000? How would you secure your profits and trim your exposure to the market in a graceful way when the market begins to fall like it did in the 2000 dot-com burst? Asking this question since I don't want to get caught in such a scenario in my life. At what time shall I trim a position after 100% or after 200%? I am confused in these situations. I hope we are not in a similar situation. Please advise, Sanjiva S. Well, that's the $1 million question, isn't it, Sanjiva? When do you sell? And it's not just when do you sell. It's when do you sell if you are participating in an outright insane mania? The only answer that I know of is that there's no one-shot deal at this. You either are a good, experienced trader who knows how to enter and exit a position, or you're not. And only you know for sure. I hate to make it binary because so many things in life are not. But I think in this case, making it binary saves a lot of people a lot of money if they listen to me. Don't assume that you will get out at the top or near it. Assume that you are a human being and you will get caught up in the frenzy as stocks go up, and you will get caught up in the despair as they go down. And you need to have your own strategy worked out. No one can answer a question of this kind in a simple way that would then lead to you directly allocating capital. Be careful, Sanjiva. Just be careful out there. Either know what you're doing or don't play. Mike S. is our last question this week. He says, Dan, help, I'm really confused. I've been following 3 commodity indexes, and lately all of them have moved very high percentages into Treasury and government bonds. Seems to me this is the opposite of what I want, owning things that hurt when I drop them on my foot. I recently sold all my DBC to buy into GSG and BCD, and now those have followed suit, so I'm selling out of them. Is this normal as they cycle through futures contracts? Thanks, Mike S. It might be, but Mike, the thing is, I hate these things. I hate these funds that, like, a typical thing will be, they're constantly rolling the first 2 months of futures contracts, right? So you get this sort of 30-day moving average kind of a thing. And, on the first day you start out with one contract, and then the second day you've got a whole lot of one contract and a little bit of the next, and the day after that, there's you get less of the near term and more of the second one. That's how they roll it, right? Maybe. I mean, it's approximately something like that. But man, I just hate these because there's just too much opportunity to constantly lose money. Right? You get this kind of thing that they call negative roll yield, right? What if you're, and it really affects things like the VIX and other things worse than that, but it can affect the commodities too. And this idea of these things, these commodity funds or indexes, like holding lots of treasuries and government bonds, they might be trying to mitigate that negative roll yield that you get. Where you're just kind of constantly chipping away and losing value because it's going against you. I hate these things, Mike. I would never buy them. I would never tell anyone to buy them. Sorry, buddy, you're on your own. That's all I got for you with that. But I wanted to get my opinion in there. Thanks for asking about it. All right, that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as I did. And if you want to hear more from Stansberry Research, especially on the topic of politics, check out Trish Regan's new podcast at americanconsequences.com/podcast. And do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. You can also follow us on Facebook and Instagram. Our handle is @InvestorHour. Also follow us on Twitter, where our handle is @investor_hour. If you have a guest you want me to interview, drop us a note at feedback@investorhour.com. Till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email, feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.